So what exactly is being priced here into the market? Are the gains that we had at the start of this year, the first 6 months or so of this year, was that pretty much it? Are we kind of now just kind of sailing adrift?
Well, Romain, it's a great question. We are giving back those big gains that we saw in the first half, and you touched on it just a couple minutes ago. It's higher for longer. The interest rates, you've seen the 10-year just bust through 4.5, 4.75. It's worries about Washington, the budget deficit, oil prices. So it seems like everything's piling on right at the wrong moment, so to speak, for the markets. We're coming out of a difficult September. October could be better, and we're still looking for a year-end rally, but that doesn't feel much like a rally today. So there's just this piling on effect that's weighing on the market sentiment.
And particularly when we look at kind of the correlations with yields, at least as of late. I mean, just today, we're up 15 basis points on a 30-year, 12, 13 on a 10-year. And that negative correlation between where yields go and where stock prices go. I am curious if anything sort of arrests that. If we get some clarity out of the Fed where they finally are willing to communicate publicly that they are indeed done and that rates are either going to stay where they're at or maybe even potentially come down, do you think that would have a material impact on market sentiment and market direction?
I think it would, Romain, but I'm not expecting that the Fed to back off on its 2% target. It's too soon. But to your point, if we get better than expected earnings, we start pretty soon, that could give the market a little bit more confidence, put a kind of a floor underneath this downdraft that we're in. So I think it's going to boil down to earnings. We know where the Fed is going to go, what they've said, a lot of talk. You were just talking about that. We've got to work through what's happening in Washington. But I think, between now and, say, the end of the month, it'll come down to earnings. And, the estimates are all over right now. But just suppose Q3 is just as good or not as bad as Q1 and Q2. That sets us up for that year-end rally. But we're not there yet.
We'll bring that higher for longer message to corporate earnings. If we actually are entering into a higher for longer sort of world, how does that affect corporate America? How does that affect balance sheets and the numbers that we get on a quarterly basis?
Well, the cost of capital, obviously, is one pain point. Higher oil prices is a tax on consumers. That could filter in the weaker consumer demand. You've got the budget deficit is out there. That weighs on the sentiment as well. So, that's going to be kind of how all this plays out. We need a circuit breaker. We need a circuit breaker for this market to kind of stabilize and push forward. But we're not there just yet. But everything you talk about weighs on consumption, consumer confidence, the cost of capital for firms. Financials will kick it off. There'll be a lot of interest around what are they seeing with delinquencies. So all these variables are coming to a head.
What sectors actually do well, if at all, in a higher for longer environment that you just described where the cost of capital is higher? Does that benefit on a sector basis, or is that more about the size of the company?
More sector. Katie, like, for instance, we're overweight energy. We like minerals, metals, the energy complex, harder assets, inflation hedge, or at least keep up over and above the cost of prices. So that's where we're looking. We're playing more defense as well with healthcare. But we had a long debate in our investment strategy committee about moving towards cyclicals, but it's too early. We're not early cycle. We're still late cycle, but that's where we're leaning. We're leaning into cyclicals, but that call is just too soon just yet. But that's how we're thinking. But energy is where we see some value, some opportunity, and some place to kind of hide out, other than, say, cash or money markets.
Cash or money market. Well, I mean, can you argue with that, Joseph? I mean, it's easy to kind of, okay, cash, money markets. I know that trade isn't going to hold up forever, but when you consider that you're able to get, 4, 5, 6%, depending on where you are, with basically no risk, why wouldn't you do that?
No, Romain, exactly. And we have that conversation with our clients every day. You can't sniff or sneeze at 5% money market. But here's the thing: since 1945, compounded annual average return of the S&P 500 is around 11.2%. So really historically, you got to see the big picture. Equities are what's going to drive wealth. But here and now, to your point, 5% on a money market, and you can sleep at night, and you're going to get your money back for sure. Where we're seeing a lot of cash, but I think that money market, say 5.7 trillion, it's more than double what it typically runs. That could be bull market fodder for equities later next year into 2025. That's how we're viewing it. But it's early on. But you're right. Take the 5% and run.